Monetary Policy Committee, that is MPC, met on 6th, 7th and 8th April, and based on an assessment of the macroeconomic situation and the outlook, voted unanimously to keep the policy repo rate unchanged at 4%. The MPC also decided unanimously to remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. The marginal standing facility, that is MSF rate and bank rate, remain unchanged at 4.25%. Further, it has been decided by the Reserve Bank to restore the width of the liquidity adjustment facilities, that is the LAF, LAF, that is the LAF corridor, to 50 basis points, 50 to 50 basis points, the position that prevailed before the pandemic. The floor of the corridor will now be provided by the newly instituted Standing Deposit Facility, SDF, which will be placed 25 basis points below the repo rate, that is at 3.75%. Inflation is now projected to be higher and growth lower than the assessment during February. Economic activity, although recovering, is barely above its pre-pandemic level. Against this backdrop, the MPC decided to retain the repo rate at 4%. It also decided to remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. I would now like to provide our assessment of growth and inflation. And first, I would take up growth. According to the second advance estimates released by the National Statistics Office, NSO, on February 28, real GDP rose by 8.9% in 21-22. Real GDP growth for the year 2022-23, that is the current financial year 22-23, is now projected at 7.2%. I repeat, 7.2%, with Q1 22-23 at 16.2%, Q2 at 6.2%, Q3 at 4.1%, and Q4 at 4%, assuming crude oil, that is Indian basket, at $100 per barrel during the year 2022-23. Let me now turn to inflation. In February 2022 meeting of the MPC, we had projected a moderating path of inflation during 22-23. Heightened geopolitical tensions since end February have, however, upended the earlier narrative and considerably clouded the inflation outlook for the year. On the food price front, a likely record Rabi harvest would help to keep domestic prices of cereals and pulses in check. Global factors such as loss of wheat supply from the Black Sea region and the unprecedented high international prices of wheat could, however, put a floor under domestic prices of wheat. Edible oil price pressures are likely to remain elevated in the near term due to export restrictions by key producers as well as loss of supply from the Black Sea region. Feed cost pressures could continue due to global supply shortages, which could also have a spillover impact on poultry, milk and dairy product prices. Average crude oil price, that is the Indian basket, at $100 per barrel, 100 per barrel. Inflation is now projected at 5.7%. I repeat, inflation is now projected at 5.7% in 2022-23. With amendment to Section 17 of the RBI Act in 2018, empowered the Reserve Bank to introduce the Standing Deposit Facility, that is SDF. By removing the binding collateral constraint on the central bank, the SDF strengthens the operating framework of monetary policy. Accordingly, it has now been decided to introduce SDF as the floor of the LAF corridor. This would provide symmetry to the operating framework of monetary policy by introducing a standing absorption facility at the bottom of the LAF corridor. similar to the standing injection tool at the upper end of the corridor, namely the marginal standing facility. Thus, at both ends of the LAF corridor, you see both ends currently after we have introduced SDF at 3.75. Currently the LAF corridor, therefore the 50 basis points corridor is 3.75% SDF at the lower end of the corridor and 4.25% at the upper end of the corridor through the instrumentality of the MSF. So thus at both ends of the LAF corridor there will be standing facilities, one to absorb the liquidity and the other one to inject liquidity. SDF absorbs liquidity, MSF would inject liquidity, and this will depend on the evolving financial market conditions. It can vary from day to day also. Accordingly, access, and further this is very important to note, that access to SDF and MSF will be at the discretion of the banks, because they are standing facilities. They will be at the discretion of the banks, unlike repo, reverse repo, OMO and CRR, which are available at the discretion of the Reserve Bank. So the standing facilities give the discretion to the banks. And the other tools I mentioned, the OMO, the reverse repo, or the CRR actions, if any, they are at the discretion of the Reserve Bank. Notably, and this is very important to note, that SDF is also a financial stability tool in addition to its role in liquidity management. So the introduction of SDF is for twin objective of doing proper and appropriate liquidity management in the current context, and also to further strengthen financial stability. So it has two broad objectives. The second point, I mentioned that there are, we are instituting several measures. The first one I have said. The second point is as follows. The SDF rate will be 25 basis points below the policy rate, and it will be applicable to overnight deposits at this stage. It would, however, retain the flexibility to absorb liquidity of longer tenors as and when the need arises with appropriate pricing. The MSF rate will continue to be 25 basis points above the repo rate. Thus, the width of the LAF corridor is restored to the pre-pandemic configuration of 50 basis points symmetrically around the policy repo rate, which will be at the center of the corridor. 3. The third announcement. The fixed rate reverse repo, that is FRRR, if I can put it that way. The fixed rate reverse repo FRRR rate is retained at 3.35%. It will remain as part of RBI's toolkit. However, its operation will be at the discretion of the Reserve Bank for purposes to be specified from time to time. The FRRR, that is fixed rate reverse repo, along with the SDF, will impart flexibility to RBI's liquidity management framework. 4. Both MSF and SDF will be available from 17:30 hours to 23:59 hours on all days of the week throughout the year, from 5:30 p.m. to 11:59 p.m. on all days of the week throughout the year, irrespective of holidays or Saturdays or Sundays. 5. It has been decided to restore the opening time of financial markets regulated by the Reserve Bank to the pre-pandemic timing of 9 a.m., that is 9 in the morning, with effect from 18th April without any change in their closing time prevailing at present. Our foreign exchange reserves stand at 606.5 billion as on 1st April, which are further bolstered by the net forward assets of the Reserve Bank. The Reserve Bank remains committed to maintain orderly conditions in the domestic financial markets and will take appropriate steps as needed on ongoing basis to contain the adverse spillovers from the global developments. I would now like to announce certain additional measures. There are, I think, 6 or 7 announcements, and I shall be quick. First announcement relates to individual housing loans, rationalization of risk weights. The risk weights for individual housing loans were rationalized in October 2020 by linking them only with loan-to-value ratios for all new housing loans sanctioned up to 31st March 2022. Recognizing the importance of housing sector and its multiplier effects, it has been decided to extend the applicability of these guidelines till 31st March 2023. The next announcement relates to SLR holdings in the HTM category. With a view to enable the banks to better manage their investment portfolio during 2022-23, it has been decided to enhance the present limit under held to maturity, that is HTM category, from 22% to 23% of the NDTL till 31st March 2023. It has also been decided to allow banks to include eligible securities, that is eligible SLR securities acquired between 1st April 2022 and 31st March 2023 under this enhanced limit. The HTM limits would be restored from 23% to 19.5% in a phased manner starting from the quarter ending June 30th, 2023.